Do you feel it? That pause at the grocery checkout when the total is higher than it was last week? Or the moment of anxiety when opening your mortgage renewal notice? Or that uneasy feeling when your credit card balance barely moves after making a payment? And Canadians across the country are feeling that very same pressure. And this is no coincidence. BNN Bloomberg just dropped a bombshell. Canada's economy isn't just slowing down, it's shrinking. Back-to-back quarters of negative growth.
Data from the Canadian Federation of Independent Business has found that there are some recession fears in the air. Their chief economist is joining us now with some perspective on what they are seeing. Simon Gaudreau, nice to have you with us, Simon. Walk us through the numbers as you see them sort of moving into the second half of the year here.
What we're seeing is an estimate of a contraction of 0.8% of GDP for Q2 of this year, and the same for Q3. So we provide short-term forecasts, and we believe that's also probably something that's more accurate to do in the current context. Very hard to predict. Even in the short term, what's gonna happen next, let alone for the long term. What we've seen in our forecasts and our estimates is that a lot of businesses are worried about what might come next. There is a lot of uncertainty at the moment, and it puts a lot of investment projects and hiring on pause at small, medium-sized businesses in Canada. And that's what may explain also, without those important components, why we have weaker perspectives for the economy.
Economists call it a technical recession. I call it a reality check. Mortgage renewals at double or triple the original rate. Home equity at risk, credit lines being reduced or denied. This is what a credit squeeze looks like before it becomes tomorrow's headline. There's fear of losing financial security, fear of the unknown future, fear of watching hard-earned savings just slip away. There's frustration that no matter how hard people work, costs keep climbing and financial stability feels further out of reach. But there's hope, because even in challenging times, Canadians can take action to protect their wealth and position themselves for recovery. For those of you who are new here, I'm Claudia Ragona, one of the Ragona sisters, and if you're looking for the hard truth, you are in the right place. Just what Canadians need to hear right now. Today we're unpacking this BNN Bloomberg economic warning in plain English, breaking down what it really means for mortgages, housing, jobs, and your overall financial future. And most importantly, I'll show you how to protect yourself so you're ready for whatever comes next. Canada's economy shrank by 0.8% last quarter and is expected to shrink by another 0.8% this quarter. That's 2 quarters of decline, a recession by definition. But unlike past recessions, this one is colliding with the largest wave of mortgage renewals in Canada's history. Thousands of households will see monthly housing costs jump by hundreds, if not thousands of dollars per month. This isn't theoretical, it's math. If you locked in at 2% a few years ago and now face 4.5% or 5%, that's an additional $600 to $1,000 every month. Renters aren't exempt either, as landlords pass along higher financing costs which drive up rents. In Toronto, one of Canada's most expensive real estate markets, higher mortgage rates are already cooling demand. If buyers can't qualify for larger loans, bidding wars stop and properties sit longer, and prices risk dropping. A 10 to 20% correction could erase hundreds of thousands of dollars in equity for some homeowners. In Vancouver, where housing affordability was already a crisis, increased rates are pushing buyers out entirely, leaving only cash-heavy investors in the game. For first-time buyers, it means waiting even longer, while current homeowners face staggering payment shocks. Out in Alberta, the oil and gas jobs have been a bit of a safety net, keeping people working while other parts of Canada struggle. But here's the problem. Interest rates are still high, and businesses aren't taking risks or expanding like they used to, keeping people working while other parts of Canada struggle. But here's the problem. Interest rates are still high and businesses aren't taking risks or expanding. That means fewer new jobs showing up and eventually less demand for housing. Basically, even Alberta's cushion has limits. The Atlantic provinces have seen population growth and rising housing costs driven by interprovincial migration. But if credit tightens and job growth slows, smaller markets could see abrupt corrections, hitting new homeowners the hardest. So when businesses sense a slowdown, they cut costs. Hiring freezes and fewer raises, they reduce hours, and they eventually have layoffs. And the BNN report points out to shrinking investment and weak business confidence. Translation: Canadian companies are nervous, and nervous companies don't hire aggressively. Add in the credit squeeze, banks tightening lending standards, reducing credit limits, and denying new loan applications. For small business owners, especially in manufacturing, construction, and retail, this could mean delaying growth plans or even scaling back operations. We've had recessions before, but this one is uniquely dangerous because it collides with a massive mortgage renewals and already high household debt. And Canada has one of the highest debt-to-income ratios in the developed world, meaning households are more exposed to interest rate changes than ever before. This is why some economists are calling it an interest rate fallout crisis. It's not just about economic numbers. It's about how financial pressure spreads from one sector to another and affecting everything from local businesses to national housing values. So what you need to do right now is review your mortgage and loans. So if you're renewing within 12 months, you need to start having conversations with your lender now. Explore fixed rate options and run the numbers for worst case scenarios. Proactive planning beats last minute panic. Second, build a cash buffer. Even a modest emergency fund of $500 to $2,000 can buy you time if income drops or expenses spike. Think of it as an inflation hedge and a safety net. Third, hold off on major debt-fueled purchases. Avoid taking on new vehicle loans, major home renovations, or luxury purchases unless you can pay it in cash. In uncertain times, liquidity is king. Fourth, diversify your income if possible. A side hustle, freelance work, or even part-time hours can create a financial cushion. This is about wealth protection, not just surviving the moment. Fifth, reevaluate your investments. Take a fresh look at where your money is parked. If most of your investments are locked into housing or risky high volatility stocks, it might be time to shift gears. In times like this, safer and more liquid assets. All about protecting what you've already built while you ride out the storm. So picture this, 6 months from now, unemployment climbs above 7.5%, and Toronto home prices fall 12%, and Vancouver sees a 15% dip. Alberta experiences layoffs in energy and construction, and Atlantic Canada's housing boom reverses sharply. Homeowners with $900 higher monthly payments scramble to sell, flooding the market with listings, and buyers hesitate because credit is tight, pushing prices even lower. Meanwhile, households leaning on credit cards hit their limits just as the banks reduce those very limits. And this is how recessions create a chain reaction. Higher borrowing costs trigger lower spending, which triggers job losses, which trigger even more cautious lending. It's a vicious cycle. But here's the good news. Canadians who prepare now can weather it by securing stable financing, reducing high interest debt, and boosting savings. You can stay calm while others panic. Canada's economy is slowing sharply, and mortgage renewals are amplifying household financial stress. And regional housing markets face unique pressures. Toronto and Vancouver risk price corrections, while Alberta braces for employment shifts. Proactive steps like financial planning, cash buffering, and avoiding unnecessary debt can help you protect your wealth through this slowdown. This isn't fear-mongering, it's preparation. The full impact of mortgage renewals hasn't even hit yet, and that means Canadians still have time to adjust. Those who act early, those who review budgets, control spending, and focus on cash flow will be in a far stronger position when the pressure peaks. So, what about you? Are you seeing signs of the squeeze already? Higher payments, tougher credit conditions, slower business at work? Comment below. Your experience helped paint the real picture of Canada's economy from the ground up. And if this video helped you understand what's really happening, subscribe now, because in the next video, I'm going to break down exactly how to recession-proof your finances step by step, a practical guide to weathering a slowdown and protecting your financial future.